What's going on, everybody? Cullen Gandy here, coming at you with another video about personal finance and mortgage finance and basically anything financial to get you down the road to where you want to be eventually, retiring early, sipping mojitos on the beach. I don't know what your thing is, but hopefully we can get you there. Today I wanted to address a question that was brought to my attention by a gentleman by the name of Setrag Shahikian. Sorry if I said your name wrong. What he wanted me to talk about today has to do with the differential between how you work as a residential mortgage loan originator, and then what the difference is there between that and commercial or larger operations as a mortgage loan originator. Now, if you're watching this video and if you're studying for the MLO SAFE test in order to get your mortgage loan origination license, chances are 99.9% of you are going to start off as residential mortgage loan originators, and all of your activities are going to be centered around that 1 to 4 unit residential family property. However, sometimes later on in your career, or maybe sometimes earlier than others, you want to break into the bigger game, you want to make bigger deals and collect bigger commissions, right? So you want to go ahead and break into the commercial side of things. Well, what's the difference there? How do things work similarly, and how do they work a little bit differently? Because, you know, when you're working with sometimes $500 million to $1 billion commercial deal, a lot more is riding on the line as far as your ability to do basic math and just check your documentation. For myself, working as a normal residential mortgage loan originator, I have enjoyed very good success, but there are some really key differences between how you're going to be originating loans as a normal MLO and how you're going to be breaking into the commercial space if you eventually do want to. And the first really big one is that if you're a residential mortgage loan originator, all of your particular ideas and all of your particular compliance items are going to have to do with the big two regulations, that is to say, TILA and RESPA. I made another video that goes into a little bit more depth about what TILA does and how it regulates the mortgage industry, and you can take a look somewhere on the screen here if you want to learn a little bit more about that. One really key distinction is that most mortgage loan originators are only going to be working in what's called the 1 to 4 unit residential property. Starting off, if you are a normal residential mortgage loan originator, the main key things are going to do with your ability to communicate clearly and make the terms of the loan very apparent to your prospective client or buyer. Most of the time, but not always, the people that are getting a residential mortgage loan aren't exactly the most sophisticated financial operatives that you're going to be coming into contact with, but everybody needs a home. And so it's very important for TILA, the Truth in Lending Act, and RESPA, the Real Estate Settlement and Procedures Act, to sort of give us a guideline of how we interact with these people, because if we misrepresent our terms to them, there's no safety net. There's no reasonable expectation that most of the American population is going to know the ins and outs of the financial instruments that we use, right? They're relying on us to give them the information they need just to get into a home. And then we have to do our due diligence as mortgage loan originators and as lenders in order to make sure that they can qualify for it, right? So we got to check them out. Trust them, but verify, because more often than not, you're going to get some people that sort of try to fudge the numbers to get into a home. Now, from a purely numbers standpoint, if we're going into the differences between the 1 to 4 unit family, residential mortgage loan origination, there is a little bit of differentiation between what is called the homeowner occupied property and the homeowner non-occupied property. And there's going to be different risk models associated with each of those two classes of, home and each of those two individual mortgages. The loans in residential mortgage loan origination that are going to have the very best terms are going to be those loans where the prospective client is going to have the highest credit score, that is to say at least 2 credit scores that are going to be above 740. They're going to have a relatively low, what's called a debt to income ratio. And I've talked about these sort of buzzwords in other videos as well. But basically, their debts don't represent too much of their income when it comes to their monthly obligation. As well, a lot of these people are going to have some assets in reserve in order to meet some of these obligations if their debt to income ratio gets a little bit up there into the 40s. If that is the case and they're applying to get a loan for what is called a homeowner occupied primary residence mortgage, then chances are they're going to get the best mortgage rate terms available. An example of a quote that I gave to someone earlier, and these aren't going to be representative of all of the the mortgage rates in your area, but I did give a quote for a 30-year fixed rate mortgage, traditional mortgage, to an individual earlier on today, and it was 2.74 with an APR of, I believe, 2.765. So it's a really, really competitive rate because you have the most competitive client, the one that is easiest able to apply and the least risk, because if you're applying for a primary residence mortgage, chances are you're not going to want to default on that because then you're going to be homeless. But that's not the only way to get some of the most advantageous pricing available. You can also see about borrowers who are really well qualified, who do currently live in primary residence owner-occupied situations currently, but are trying to buy another home. And these folks could still actually have homeowner occupied pricing available to them even if they don't intend to full-time move to the second property. So how can that be? Well, you could try to get the borrower to apply for what's called a second or vacation home, and that is considered a homeowner occupied property if we can establish that they intend to sort of live there for a reasonable amount of time during the year. If like 6 months out of the year they're living there, then there's a good shot that we could get them homeowner occupied pricing for these second homes, which is basically equivalent to primary residence pricing. So what are the stipulations? Like, what do you have to do in order to be able to get second home pricing to be as good as primary home pricing? Well, one thing that you really want to make sure of and take care to note is how far away that property is from their primary residence. If they are buying a second home and it is in the same neighborhood as the first home, that sort of throws up a red flag that perhaps this isn't a second home or vacation home that they're going to go away to in the winter to get away from the crowds or the cold or anything like that. So chances are you're not going to be able to qualify for anything that's within, I'd say, 50 to 100 miles away, unless maybe if it's 30 miles away, but where it is, it's considered a resort area, or if there's a beach nearby, or if there's some sort of reasonable expectation that people would go there to get away from things, or in order to engage in a new school district, for example, if they wanted to bring their kids to school there or something. If we can establish that, there's a good chance that we could validate second home status or vacation home status and get that homeowner occupied pricing for them. One bad thing though is if these borrowers do sometimes want to rent out the second home, or if they want to sort of extend cash flow that they're getting from, let's say, Airbnb or something like that, we cannot use any rental income or any sort of cash flow that comes in from any kind of temporary or long-term tenants when it comes to secondary home status or homeowner occupied status. So if your debt to income ratio is really riding on the fact that you want to use this this tenant's income for the qualification process, but if it is considered a homeowner occupied property, you're kind of out of luck because we cannot use that. That's the very nature of homeowner occupied second home or vacation home status. Now, the third and probably the most, I would say, commercial of the residential mortgage loan origination activities that you're going to encounter within the scope of TILA is going to be the homeowner non-occupied property or investment property. And these are the properties that are going to get a little bit less favorable terms because the risk model is skewed towards, trying to get a little bit better of a margin just in case, the economy takes a tank, big downturn, and they have to give the property up, or God forbid, they foreclose on the property. Because think about it. Who's going to foreclose first? If you have two properties, one is the place that you live, and one is the place that you like to rent out on Airbnb on Fridays and Saturdays to make a little extra cash, which one are you going to let go of first? For example, I did have an individual that did do what's called a refinance refinance on their primary home. They got a really fantastic sub-3 rate on their primary home. And then they said, hey, Cullen, this is really great. I want to go ahead and do my second property. It's a rental property. It's a cash flowing property. Should be really easy peasy to underwrite it. You know all of my information. I said, hey, no problem. I'm going to go ahead and shoot you over a quote with all of the rates that are, applicable to that property in that zip code, and we can get you started. And lo and behold, they were like, oh, wait, these rates that you're quoting me on this seem to be in like the 3.6s and 3.7s, where my primary residence was, I think, 2.875 or something like that. What's the deal? And it's just that. This pricing model for non-owner occupied or investment properties that are not second homes, that are not priced as homeowner occupied, are going to have risk models that compensate for that non-owner occupied status. When it comes to qualifying those borrowers in that 1 to 4 unit space as a residential mortgage loan originator, it's going to be pretty streamlined because, again, you're not going to be dealing with real estate savvy or financial instrument savvy type folks. If they're employed, it's going to be fairly straightforward. 2 years of tax returns, the 2 most recent pay stubs within 60 days. You're going to want, the last pay stub for each of the preceding years. And that's pretty much it. If you're self-employed, it is a little bit more in depth. In fact, during the pandemic, self-employed borrowers kind of got even shorter ends of the stick, having to provide more things like profit and loss statements, year-to-date profit and loss statements that are either audited by someone like a CPA, or if they're signed by the person in question, that serves as like an affidavit of the the factual status of the profit and loss statement. 2 years of business and personal tax returns, and all these different numbers. This can bite you in the butt. If you say all these different numbers in the profit and loss statement, but they don't match up with your business and personal tax returns in the right way, this can really sink your ship, so you have to watch out. Now, the process for qualifying borrowers as self-employed persons is the most similar process that you're going to be able to find in the residential space as a mortgage loan originator to what we're eventually going to be talking about in the commercial space. Now, full disclosure, I have not worked in the commercial space of the real estate mortgage loan origination, but there are several key reasons why this is an entire different beast altogether. First of all, there's not going to be the same kind of streamlined licensing requirement nationwide that exists for residential mortgage loan originators. In fact, many residential mortgage loan originators in certain states are able to just go into commercial mortgage loan origination if they have some sort of mentor or if they work for a mortgage brokerage or a mortgage bank. However, that might not necessarily mean that there is no license that exists for your commercial mortgage loan origination operation. In fact, certain states, I know for a fact, have very specific licenses for very specific commercial operations, right? So just apprise yourself, make sure that you understand which states need what licensure and which states don't necessarily need extra licensure for the commercial aspect of the mortgage loan origination business or the lending business. In the commercial space, when you are validating and sort of qualifying these big commercial players, there is the insinuation that a lot of these people, a lot of these clients that you'll be working with are more sophisticated borrowers and clients. And as a result, they're going to be a little bit more in tune with what they need to do in order to get these big deals closed. In commercial real estate deals, you're going to need all of the regular, tax documentation and income documentation that they might be doing personally if they're doing it personally, but more often than not, these are going to be self-employed individuals acting under what's called a limited liability corporation or an S corporation or something like that. In this case, you're going to want to know things like the net worth of the individual that you are dealing with, the credit worthiness of their personal credit history and or their business's credit history. But then you're also going to want to know things like their experience in the particular industry, in that commercial industry that they're trying to sort of expand into, right? And conversely, as opposed to a lot of residential deals, you're going to also need to know specific really important things about the deal itself in order for the client to be able to qualify. For example, things like what is the capitalization rate of the deal in question? Is it going to be worth the money to actually get this loan, to give this loan to the client? Are they going to be able to make money off of it? This is a really important, notion, because a lot is riding on the line when it comes to the client's ability to repay, because it is directly linked to their ability to get business going in the commercial sector, or get mass amount of tenants in their development if it's a large residential development. You're also going to want to know things like the debt coverage ratio and the debt yield, and those are some things that you're going to probably hear me talking more about in future videos when it comes to the nitty-gritty of these kind of more commercial deals, even when it comes to the 1 to 4 units, but it's mostly single family home investors. These are things that you want to know kind of in an ancillary way to make sure that these people are going to have the ability to repay you back. You're going to need things like any leases for any tenants that they may have already engaged during this process. You're also going to want to know things like cash flow statements. Are they cash flowing? That is to say, after all of their obligations are met and taxes are paid and everything, what's coming back to them? Is there an established amount of cash flow, right? You're also going to want to know if they have a lot of future tenant obligations and tenant obligations that they anticipate having after the settlement of this large commercial deal. What you would want for a regular residential buyer: income and expenses, or otherwise known as things like profit and loss statements. Are these people profitable in their business? Is there rent rollover? Is there a lot of exchanging between tenants leaving, tenants going, right? But you're going to need more specific information about the deal. For example, things like floor plans, which aren't really a thing when you're talking about originating like a purchase on a single family or a duplex or something like that. Floor plans, how is it going to be any different than what it already is? Well, in commercial real estate, it can be very, very different, right? You can do a lot of different things with it. And finally, like a lot of initial, like if you're doing a new build on a residential building, you're going to want to do all the same kind of site surveys and things that you would have to do there. So like an environmental survey. How is this development going to affect the area and the environment around it? So going to want to know if there's any engineering reports, what those come back at, and how those can affect the deal. If there's a major engineering flaw, just like if there's a major flaw with like a foundation in a single family home. Commercial deals, like all residential deals that are covered by TILA, are going to be blanket covered by the ECOA Act, and that's the Equal Credit Opportunity Act, and that's going to basically govern anything that has to do with people who reserve the right to apply for and receive credit based on the merits as a person, right, in the United States. I hope a lot of these things that I said sort of clarify what the difference is between your normal residential loan origination activities and the activities that you're going to be engaging in for these larger commercial real estate loans that you might want to consider doing later on in your career. We call them CREs. And there's a few more moving parts, but like anything, if you get in the hang of it, it can be really profitable, and it can also be like you're on autopilot. You've done one thing, you've done it all. So you just keep doing it, and all of a sudden it becomes second nature. That being said, guys, I hope you really enjoyed this video and found it informative. And if you did, please hit that like button for me. Go ahead and consider subscribing and hit the notification bell so I can inform you of more content like this. And hopefully I will see you in future videos a little bit richer and a little bit happier. Peace.